Price. That's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Hi everyone, welcome to another episode of Opto Sessions. I'm Ed Gotham, and today we've got the pleasure of inviting 50 Pips back on the show for a deep dive in the markets and, as always, price action. We talk the US election and how you should have a game plan regardless of the outcome. 50 also takes us through the major levels in gold, S&P 500 and Nasdaq, and we finish by discussing the importance of removing your bias. Enjoy, everyone. Good to have you back on the podcast again. How's your week going?
Hello, thank you for having me back. All good, busy, plenty of stuff going on, so I can't complain.
I thought we'd roll straight into it and see what's catching your eye in the markets at the moment. Is there anything in particular that's interesting this week?
I guess that would depend on what time frame, not on this specific week, not really. I think here we're just we're chopping around, right? The market is waiting for some kind of catalyst. We're going towards the election. Markets waiting or hoping for some kind of stimulus bill. Same old from the central banks. They're pretty much begging governments to do their part, do fiscal, do something, and not rely only on the central banks. And everything's a little bit up in the air. I think most people are focused on the same trades, the way the central banks have positioned themselves, try and stay long risk, stay long bonds, stay long equities, short the dollar, right? And so again, but essentially we haven't really moved that much. I think what's interesting is that the normal seasonal patterns are playing out quite nicely. There's beautiful little sell opportunity looking for that seasonal pullback September into October. Then when we went through quarter end, month end, and quarter end, that set up a beautiful little buy, which is currently in play. All of a sudden, the indices are back above their 50-day moving average after having come back, and pretty much everything across the board held that 100. So I think it's very technical. It's interesting. I think we can't complain this year.
And regards to stimulus, is that if we do see more stimulus, and I mean a lot of people are thinking that's quite likely, is that just going to ramp the equity markets more, or has it already been priced in? What are your thoughts on that?
I don't have a crystal ball, so I don't know. You would assume that it's priced in, but then again, I'm not really a fan of trying to pontificate or try and to see what's going to happen, because as always with all the news, when Trump got elected first term, nobody knows how the market's going to react. What's important is, of course, how the prices, how the market is positioned and what they're pricing in. I think it's fairly easy to have a structural view longer term, and it's fairly easy to have a shorter term tactical view. But these midterm views, I tend to prefer to go with whatever price does that. Of course, there's an overlay in terms of the way you'd be thinking about it, right? Here, you're thinking about it, okay, the market is behaving very tactically, very, very technically overall. If you look at how the market tends to behave normally, we have that heavy September, and then we ramp up into the end of the year, right? If we look at how markets tend to trade also in the fourth year of a presidential cycle, the difference is that September, also October is a little bit heavy, but then we get that ramp up. So ultimately, I tend to believe that the market will do what it wants to do, and the narrative will somehow justify it. So, it is what it is. But here, if you're looking at it, we're still in a situation where the market wants to believe. right? The market wants to believe. Now, you can argue it's because the politicians or the central banks are just pushing everybody further down the risk curve, which is inevitable with the way rates are and what they've told us about rates going forward. So the market kind of has no way out. So it's in a situation where good news is good news because you got to be long, right? And bad news is good news because don't worry, they got your back. They're going to do something to fix it. So unless you get some kind of really unexplained or unexpected shock, it's difficult to see how you can be structurally bearish. Now, of course, you can talk about the fact that this is a Ponzi scheme. You could be upset at all you want, but that's been the case since 2009.
Yeah.
And so again, and as I like to say, you can wake up every day or every Monday looking for a Six Sigma move and looking for everything to come crashing down, tumbling down, because that's the way you're programmed. But the reality is that even in the context of what's happened, we had a 30+% correction in March off the highs. And as I said, when we were trading below 2,400, you have to entertain the possibility, especially with what the Fed done, that's it. That was your big correction, right? And then along the way, we've had other corrections. I mean, if memory serves, I mean, we had that another 10% correction pretty much in the ES.
Yeah.
Here recently, which is again very beautiful move, also lining up with the seasonal, we had another 10% correction.
Mm-hmm.
So it is what it is. Does that mean that I think it's sustainable? Does it mean this is how I'd be running policy? No, but that's not what I'm paid to do. I'm paid to come into the day every single day with some capital to allocate, decide whether there's an opportunity that makes good enough sense for me to put that money to work, and do my best to manage my risk and try and bank a coin every day.
Yeah. Everything
else is for, pub talk, or for people whose job it is to write articles and pontificate on these things. That's not what I'm here to do.
Yep. And in terms of the market activity around election time, you touched on it there. So do you typically see up until the results come out is basically pretty sideways motion, or even down, because the market is waiting for a decision to be made, and then you sort of mentioned that after that's made, it tends to sort itself out and start sort of pushing up towards the end of the year. Is it, in terms of historically, that's what happens?
I think here it's people love to put things in boxes, right? And compare things to means or averages or whatever, right? It's kind of like the example of what happened with Trump, right? Not to get political, or I don't want to get anybody upset, but just looking at the facts. So just to give you a small example, what happened on Friday? So Trump announced that he had COVID, right? And straight away, what people did is people started going on saying, oh, okay, so Trump is 70 something years old, 74, 75 years old. He's slightly obese, et cetera, et cetera. So the chances of him dying or to what usually happens in this, because people want some kind of certainty, right? Now, they completely forget the fact that, he's got access to the best possible care money can buy. He's going to have people watching him 24/7. He's being helicoptered to the hospital. So how could you possibly want to compare his case of getting COVID at that age with that weight with a national or world average? What sense does that make? Right? Is I was having the discussion the other day with somebody said, it's like, I deadlift 150 kilos or, 6 plates, whatever. And somebody will automatically make a judgment on what that means. But if you don't know how often that person trains, if you don't know how much that person weighs, how old they are, it means nothing. So equally, going to a long-winded reply, you can, of course, people can tell we haven't scripted this, but as I'm thinking through it, but is going into the election, how many times, you can have an idea of what usually happens, but how many times have we gone into an election with a president like Trump having to deal with an opponent like Biden, going into an election where we know it's going to be contested. We know that likely even we won't know the results of whatever. First of all, is it even going to take place, or are either of these two guys going to be in hospital, right? If it takes place, we know it's very likely that with all the mail-in votes, we won't even have the proper result. Maybe 2 weeks after. We might not even know for 2 weeks. We've already had Trump tell us that he's not even going to probably accept the results, because either if he wins, he wins. If he doesn't, it's rigged. So why would I possibly, I'm just giving you the way I think. Why would I possibly want to introduce a bias into my mind on, I think this is going to happen, this should happen, and I'm going to try and trade it like this based on what's happened in the past? I'd much rather go into it thinking about the bigger picture and looking where price is with respect to certain key levels, support and resistances, and then see how it reacts at specific support and resistances as it starts to move.
Yep.
In my way of trading or thinking, and again, there's no right or wrong way, I prefer to do that because that means that I'm a lot less committed to anything. I'm a lot more nimble. I don't have any bias I'm just going to be free, free like water, to just go wherever I need to go. Because what I like to say, I think both whether you're looking at what usually happens, or I think we're at a stage that you could probably make an extremely good, a fairly decent, eloquent case for why, if Trump wins, markets are going to wobble, or if Trump wins, markets are going to skyrocket. And the same thing for Biden. Now, of course, naturally, you tend to believe markets would stay more bid and much easier if Trump wins than if Biden wins. But I think with all these things, we don't get paid for making eloquent arguments, right? We're getting paid to. So that's my long-winded answer. If I had to give you something more concrete, and what essentially I've been looking at for a month now, or for me, if you have to have a position on, if you have to have some risk in the market, I think that the best, I would never have a naked position on, but my preferred position would be, and has been, to be long either YM or Russell against Nasdaq short. And that's possibly a trade that can continue for a long time, right? Because of whether Trump or Biden wins, effectively tech has had a huge run. Tech also benefit from the lockdown and the panic. Essentially, tech became the new safe haven, right? Safe haven. And now what we're seeing is, no matter what happens, sooner or later, the economy is going to pick up again. Things are going to pick up again, whether you get stimulus or not. And we've seen that they're going to continue to help the traditional blue chips, and things will, if things free up and get better, that will help the traditional economy. So you'd expect to see money coming out of tech and moving back into the old traditional names, and even under Trump, and if everything getting better, right? And even if we get a situation where Biden wins, he's going to want to help the economy, etc. But he's also going to be much tougher on tech. He said so, and that would probably bring more headwind on tech. So I think I prefer not having a completely binary bet, and I would not want to have a bullish or bearish bet or a naked bet. But I prefer to have, if I have to have a structural view, I'd rather look at it in the sense of what kind of position can I have on to somehow mitigate my risk, but where I have the best possible chance of being paid on both sides, or again, being paid a lot more if I'm right and not losing that much if I'm wrong, with some kind of a hedge. But I think ultimately it's a trade that would buy you duration, and ultimately, and it has been paying big for not only if you're looking at it on a multi-week horizon, but also a lot of days intraday. Today's a great example. You know, RTY is up 1.2% still. Russell's still up over 1%, and Nasdaq's down 0.5% pretty much. So I think if I had to, that's the way I would look at it. I try and take politics out of it. I try and guess specific knee-jerk reactions, just try and look at the bigger picture. That's the way I would look at it.
And what have you got the in the Russell and the Nasdaq? Are there some like key levels you're watching that would, like, big ones that might be the levels coming up into the election as well?
Well, I mean, if you're like, I'm holding the position, but I mean, if you have that position on, you don't care about levels, right? Because you're just playing on the spread, right? Here, I mean, whether you're looking at the Nasdaq or whether you're looking at the ES, essentially, there's something that is evident, right? Is that we're stuck pretty much at, if you look at the ES now, for example, we're stuck around 3,400, right? Incidentally, 3,400 is where we puked in March.
Yeah.
So, you know, we unwound, and our base case was after the March low, and I think I might have discussed it with you. I'm not sure if in the last time we had the podcast, but after we bounced off that 2,400, my base case assumption was that you have to be ready for that low to be a significant low and could possibly be the low in this cycle. But my bet was that from that March low into the election, I expected, broadly speaking, the ES, so equities and also the dollar with the high and low it put in, to be stuck in that range all the way into the election. Because we need to have some catalyst, and it'll be very hard to have one unless we get through the election. Now, what happened is wrong, because we broke through that 3440, but then we came right back in with that 10% correction in September. So you see, essentially, we've gone right back, and the same thing with the dollar. It's trying to hold outside that range. But essentially, this is what's happened. The market had that euphoria and the puke where the central banks say, okay, that's it, guys. We got your back. Just don't worry. We got your back. Powell can't. We're going to do whatever it takes. We're coming in. We're buying bonds. We're sorting it out. So if it happens again, we're going to buy stocks. By the way, we're, you know, the world, don't worry. We got your back on the dollar. We're not going to let it go cocaine angel crack higher because it's going to blow up everything. And that set the boundary. And now we're stuck at that boundary. So here, whether, as long as we stay inside that range, it's just all chop. So here on the ES, clearly, if we break back above and hold above those March highs, well, what's going to attract? What's likely going to attract is the highs we put in September before the puke. If post the election, we can't break and we're still back inside this range, well, probably is some kind of a correct reversal to the mean. And what you'd be watching to the downside are those 200-day moving averages. But again, it's also hard to look at a specific level because you're going to have the action, and anybody who traded, the past election knows you've got stuff hitting in the overnight market with the liquid market. So, anything's game, it's seek and destroy. It's twilight zone trading. So it's hard to, what's going to be more interesting is be the day, the week, how we close around the levels, not what happens on a specific day. Also, because again, as far as I know, we might not have the results for 2 weeks.
Yeah. Do you tend to, with this inevitable volatility, strange market action, chop, is the best, and if we know that's going to be the case, is the best place to remove risk from the market or stay out?
Well, it depends what you're doing. I mean, in general, I don't like the concept of removing risk completely if you're somebody who's paid to take risk, right?
Yeah.
I think what you have to do is manage your risk. So I'm not a believer of, oh my God, I have to get flat. You know, I'm a believer in, okay, we're trading VIX is at 30. You can't trade the same way as if VIX is stuck at 9. If we've got a VIX at 70, you can't trade the same exposure when the VIX is at 20. I think everything is manageable to a certain extent if your risk is in check. But so again, if you're asking me as if I'm managing a long-term ETF portfolio, long only position, what do I do into the election? I don't do much. I do nothing. I might want to hedge some risk over that week, right? By selling some kind of percentage worth, just to hedge some of the risk if I'm really worried about it, you know. But you know, if you're just managing systematically stuff, you're probably not too you're probably not too worried. If you want to neutralize risk, you can easily hedge that out and neutralize risk completely if you're scared for that overnight session or those 2 weeks, right? Just hedge it out completely, get yourself neutral if you want to. Yeah. But for me, as more of an active trader, what I will do, and again, it's hard for me to say now. Again, I'm sorry, my answers are not always fun because
it's important. I think your approach to it is really well structured. I think most people should think of it in that way. So it depends. So here, if you ask me now, what would my approach be going into election night? It's hard for me to say because it's not the same if we're going into election night and the ES is trading 3,700. It's very different what I would do if we're going to election night if ES is stuck here at 3,400, or if we're going into election night and ES is in straight fall and we've had back-to-back 5% days. Yeah. So
it's always going back to that context, right? Without the context, it's very hard to give you a nice answer. Now, I assume, you'll probably get the guys going, oh, I'll be completely flat because I don't want to have any risk. That's politically correct view, right? Or somebody's going to say, I'm going to be shorting the hell out of it, or buying, I'm going to stay long. But that doesn't really mean anything because we don't know what's going to happen. We don't know. Trump and Biden might both have COVID by the time people go out to vote. It's just, there's too much uncertainty here. Right? There's too much, there are too many knowns and unknowns here on the table. So the way I can give you a concrete answer, the way I'm tackling it now is that I am probably carrying overnight something like 25 to 30% of my max risk exposure. And I've been doing that for about a week or since quarterly, the end of the quarter, and I'll probably be reducing that. So, I'll probably be moving towards 10 to 20% max exposure in the overnight session. And right now, my plan would be to be flat before going into the event, completely flat.
Yeah. Okay.
It would be. I would say there's probably a 95% chance, or 95%, 90+% chance, very, very high chance that I will be completely flat going to the event. If I think something is really out of whack and something's particularly interesting, I might have something on. But if I have something on, it will probably be because I think the risk reward of having something on is just so big that I will only need to have something like 5% of my max exposure on, because if it works, it's going to pay multiples of what I'm risking. I don't need to. I want to be, if I'm wrong on it, I want to be wrong quick, and I want to be wrong with little, and to be back flat and have possibility to move either direction.
just coming back to the max exposure percentages you're given there, is that you're comparing it to your complete total account size? When you say 30% exposure held overnight, is that what you mean?
That's what my max risk I'm willing to take, right? So that's my max open position I would have, right? So
how does that max position compare to like your account size? Just in terms of ratio?
In terms of leverage, yeah. I mean, and again, I don't know, this might or not be controversial, but what I always talk about is size kills, right?
Yeah.
If you trade 1-to-1, so with no leverage, you really have to try very hard, and even there, it's probably hard to blow your account, right? You have to be gifted to blow your account trading 1-to-1. Let's put it that way. So having said that, the key is to trade responsibly. Now, people will have all kinds of different risk parameters and all kinds of leverage, and that also depends on not only on your risk tolerance but also on your account size. Paradoxically, smaller the account, theoretically, especially if you want to build that account or live on, you're going to have to lever up a little bit more. I think most junior traders or people starting out think, oh, I'm going to trade 1-to-20, 1-to-50, whatever, right? Crazy amount of leverage. And they think, I can't wait till I'm trading a 7-figure account, because then think of what that means. It's huge. Whereas usually what I say is, you'll see, the luxury is that the bigger your account is, the less risk you have to take, right? So again, my max leverage is going to be very different to somebody else. Okay. So on my core account, so on my main account, which is a fairly large account for most people, my leverage is around 4.
1-to-4 maximum.
Okay. Yeah. I'll trade around that. I might trade, around 3-5, but 4 is the sweet spot for me. 5 would be rare. And then on some more systematic accounts, I trade some more aggressive things. The leverage might go up, 6-9 range. Mm-hmm. But that's again, they're different strategies, different profile. But again, the issue is most people will backtrack into that and go, because they've been lied to, or people think, yeah, I can open a futures account with $5,000 and go out and trade futures. Sure, you can, but you're not going to last very long, right? And even if you make a lot of money for a couple of years trading that kind of leverage, you're going sooner or later, it's just the maths. You're going to give it all back. And then people tend to back into it, and they look at how much that would mean, how much they need to live, and they go, hey, they look at their account side, they go, you're crazy. It's not possible. You can't trade that kind of leverage, single digit leverage. It's just, there's no way, I can't make a living that way, because they're looking at the wrong way around. It's not the leverage that's too small, it's that your capital is too little for what you're trying to do, right? And that's the problem for a lot of retail traders, is because the books, the movies, the blogs want you to dream, or a lot of them are written by people who don't actually trade for a living, or want them to trade or sell them crap, whatever. It's just people don't have realistic expectations. But most retail traders, most non-experienced traders would probably be shocked if they, knew how little leverage, professional trader will take compared to what they think they should be taking. And again, take any of these, you guys know it at CMC, now that you have to, when you got CFDs, whatever, you have to put on the website what percentage of your clients lose money, right? And there's these astronomically high numbers. Now, I guarantee you, if you took all those guys and they did exactly the same trades, but you put them on 1-to-1 leverage, there's a good chance, right? Well, first of all, a lot won't. They'll all lose a lot less money, but it's pretty evident that a bunch of them might actually be making money.
Yeah, very interesting. And then do you? I'm just going to put around to silver and gold now, because a lot of people have been following them real close, because obviously they've been having some massive rallies, really sharp pullback relatively recently. Are these on your radar? If so, what are there some key levels that you're looking at? They both appear to be in sort of long-term uptrends, but obviously anything can change.
Yeah, I mean, joking, I always say is that you got a lot of retail traders, when they get attracted to trading and the excitement of trading, they all start saying, "Oh, I day trade gold, or I day trade silver or crude." They love saying, "Oh, I trade gold or crude." I don't know why, because one shines and the other one, I don't know, right? And then you'll see that the ones that don't blow up don't trade them anymore intraday.
Yeah.
Right? There's a reason for that. So by the way, so again, I think gold is a similar thing. Is the central banks, it's just clear, have told you, right? You don't be short gold, right? We're never going to raise rates again. We're going to push inflation. We need inflation to go crazy, right? Above our 2%. We're not even going to think about raising it. We're not even going to thinking about raising it, even if it's at 4%. So all that means is no matter how much you hate gold or whatever, you've got gold bugs versus the guys who think it's a pet rock. Yeah, the trade's there's only been one trade really, and that's long gold. That's long gold. That's that's the only trade that's been the only trade in town in terms of structural trade. Now, also, it just so happened that it's been extremely technical, because it retraced when it started to puke in 2008, 2009. That puke basically bottomed down around the 50% of that whole move up. It bottomed back down around 2014, 2015 at the 50 back. And then it came back. So I think some people might call it, I don't know, don't quote me on this, but, saucer, cup and handle, whatever these, I'm not into these kind of patterns, but basically, right, it just broke up and it went right back into those highs. So right here, if this move is in play, this would be pointing to, 2300 area. And here, the way this is structured, the way this is trading, this could easily, on the larger time frames, this could easily pull back all the way into 1,600, 1,500, and that's still a buy for that 2,300. Now, of course, you can't, after you saw that monthly reversal 2 months ago, you're not going to get, you're not going to get long there. But I think if you're trading it structurally, you have to have taken some off. You have to keep some on, because you just don't know. This could completely go crazy. It might not give you a pullback at all. There's very little reason to want to be short gold. Yeah. Now, again, I'm not saying you need to go. I'm talking from a trading perspective. We're not talking about hoarding gold or whatever, right? But from a trading perspective, it's bid. And I pointed out the other day on Twitter, I think everything pretty much churned at the same time. The markets are really in sync. So I don't know if you have a chart in front of you, but what you can see is that back at the end of the September, when we put those lows in, you'll see gold bounced at the 100 DMA, ES bounced at the 100 DMA, YM bounced at the 100 DMA, silver bounced at the 100 DMA, Aussie bounced at the 100 DMA, Kiwi bounced at the 100 DMA, CAD got sold at the 100 DMA, Swissy got sold at the 100 DMA, Cable got bought at the 100 DMA. Start to see a pattern? If the markets are completely in sync. So in my humble opinion, the only people who are complaining about the price action are people who have a bias and want something to happen that's not happening, because the markets, have they been choppy? Yes. Have they been technical? 100%. They've been in sync, both from seasonal perspective, both on how they're behaving on news, also on how they're in sync with one and another. So again, and here it looks like we're trying to see here. It looks like there's a potential turn here with a little bit of a correction with some kind of a little bit of dollar strength coming in, and that could mean a little bit of heaviness on the equities. But the bigger picture hasn't really changed.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
Do you think it still looks short-term timeframes, looks relatively strong, it's getting bid, even though it's got a bit of resistance up higher? I think around the 94 market came off.
Yeah, I
recently.
mean, for me, everybody was getting excited when dollar broke above the 94, right? Has it broken out? Has it broken out? And as we've been saying, remember I told you about that high and low on the ES, right? That's the range that's being put on the dollar. You can see it. It's the low in March, hence the low on equities when we puked, and then you have that that high afterwards. Sorry, the low before the March puke, and then the high in gold, which is the low in equities, right? And we've been stuck inside that range all year. And you notice what happened, that low on gold, on the dollar is not at 94. That low is at 94.50, pretty much. The low on the 9th of March or 6th or 9th of March, that it's at 94.50. And what happened? We rallied all the way back into that 94.50, and then we're trying to sell back off. So far, this is extremely technical for the continuation. What you have to watch, what is key now, is how we behave at that 50 DMA, which is where equities are looking for a direction, where the Swissies looking for a direction, where Euro's looking for direction. And that's coming in, broadly speaking, around 93.20. But again, look at it from a day close. That's important. So as long as the dollar holds above this 50 DMA, then there's a chance that we try and ramp back up and get a bigger correction into the 96 zone. If we lose that 50 DMA, then it probably looks like the next leg is back down to test those lows. Now, most people will say, hey, 50, what kind of a cop-out is that? Well, this. Well, I'm sorry. It's just, just the jokers go out saying this is going to happen. I don't know what's going to happen. I have no idea what's going to happen. The only thing I know is I can try and highlight important points on the chart, key inflection points on the chart. And I tell myself, if this happens, then I think this is the most likely occurrence. And if this happens, then I think that this is the most likely occurrence. And that gives me a chance to structure trades. So I'm not looking at levels, or I'm not looking at technical analysis like it's some kind of fortune cookie, or I'm fortune telling, or they predict the futures. No. Now, if anybody has a crystal ball or a magical fundy view that always plays out, go ahead. But that's the way I look at it.
Well, one of the reasons we love having you on the show, and I've followed your stuff for a long time, is your viewpoints like that is quite specific to how you look at the markets, and I think it's a great way to do it and avoid becoming too convinced or overconfident that something is going to happen and then end up positioning themselves. If it moves the other way and the other scenario happens, then if they're levered up and stuff, that's when you lose your account. So.
Yeah, because the problem is also we're in a situation, markets used to be simpler to a certain extent, even though the patterns are still there, whether you're looking on how market tends to trade Friday into Monday, Tuesday, whatever, the patterns are still there, seasonals, but markets were a little bit more simple here. The issue here is that we've got so many, predicting the future has always been hard, right? And the longer the time frame you choose, the harder it is. But here we're also in a situation with so many open variables that we've never had to deal with. COVID, non-COVID, Trump, Biden, a vaccine, non-vaccine, stimulus, rates, pension problems. There's so many things going on that it's really hard. The only advantage you have here, to a certain extent, from a bigger structural view, is that the central banks have told you exactly what they're going to do. So if after, and we were short into that 2400 on the yes, if after that you've been shorts since then, you're just not paying attention. You're not looking at what's going on. You're not looking at the intermarket dynamics, and you're not listening to what everybody's told you. Now, on top of that, we're in a situation where you can probably make a very good case for why the markets, again, have to crumble or completely skyrocket, no matter who wins, no matter what the central banks do, no matter what happens with COVID. We're at a very tricky inflection point where you can really, if you think about it, you can probably make a very good case for both things happening. And that's usually when traders get in the most trouble, because both people get extremely stubborn on both sides. And on top of it, people try and analyze these dynamics and have to deal with these biases, which are sometimes not even on the same time horizon. And then it just becomes a huge mess. So again, it's not like nothing's happening. There's just so much risk out there. I prefer to look at it this way. I prefer to do it this way. But again, there may be other ways.
Yeah. It sort of segues quite nicely into, I just wanted to chat for a little bit about trader psychology. You could say that the biggest fight is always against yourself, sort of like how we're talking about, how your mind works and what the decisions you make. How have you learned to sort of take your ego out of the equation when trading?
Well, I think there are a couple of things. First of all, it's impossible to work on that unless you have realistic expectations, right? And so the first thing you have to do is take away some people genuinely, whether they read some Instagram stuff, whatever, but some people genuinely believe that, you're going to come in and make 20% a day or 10% a day or what, so you've got no hope if you don't have realistic expectations. But the point about working on your ego is that you have to decide to do it. The good thing is that if you don't decide to do it, the market will do it for you. And that's why it's very rare to find people who've been trading for a long time or be able to trade for a living that are not quite zen and humble. Now, they like to talk smack, right? But even the guys who like to talk smack, if you've been doing it for a long time, it's for show. It's not what you're acting very differently on your account sometimes. But really, if you've been doing this for a long time, you just get humbled because the market just takes no prisoners, and it's very, very good at humbling people. So ultimately, the market tends to beat it out of you. Yeah. And
do you have an example of sort of when at some point you must have been learning as well. Have you got an example of a badly sort of managed trade that taught you a lesson?
I don't know. I take so many trades. Take your pick, right? But there's probably so many.
Okay, common scenario, maybe.
I mean, I think for me, it's not a trade. I'm trying to think. But for me, it's just there's a time where two things happened, I think, at the same time. One thing was that, again, this might get confusing because I'm just thinking about it now. Two big realizations, I think. One is that nobody knows anything. And the second thing is that you have to have realistic expectations, and that means you have to trade smaller. Okay, so deconstructing those things. When you know whether you're studying finance, economics, whatever at school, whether you're reading before you go to school, whether you look at TV channels, whether you read banknotes, whether you listen to important people, people inherently grow up thinking that some people know something, right? I always tell my better half is when you walk into a store, right? Oh, let me ask somebody for help. Why would you assume they know anything, right? Or it's like you assume somebody can drive because they drive a cab. Wrong, right? We all know wrong, right? So, and what you realize is if you've been around the financial markets for a long time, you realize that most people just are one-trick ponies and always talk about one thing, and they're either right every couple of months or every year or every 10 years, but nobody knows anything. And it's not, I'm not saying that in a bad way, right? But usually the smarter people are, the less they really know. And what that means is that nobody knows what's going to happen. Nobody knows what the market's going to do. And you can construct a very smart thesis for both short, long, or long, short, and neutral view on anything pretty much most of the time. So you have to forget that somebody knows something, that somebody can read the future. The only thing that will neutralize everything is price. Price never lies. And by price, I just mean looking at a naked chart or a naked quote, just how price is reacting at specific levels. Then you can overlay that with indicators, whatever. But there's no secret thing. And that means that you have to work on finding your way to read the markets, to analyze price, to structure your trades. Ideally, do it in the simplest possible way. And my quest is always to make things simpler. So even if I have something I look at on my charts or an indicator or a specific instrument I have up on my chart, every year, at the end of the year, I say, what positive contribution has this had, right? Having, for example, having copper on my screen, or having this indicator, or having this. If at the end of the year, it hasn't had a substantially positive contribution, I'll scrap it. I want to keep things as simple as possible, right? It's kind of like a good golf swing or a good punch. The simpler it is, the better. So that's it. And the second thing is the realistic expectations is that you have to trade smaller. There's just no other way around it. You have to trade smaller. You can't be trading all the time. There's not always a good trade out there, and you have to just dial it back, because you can trade also much higher leverage and press it, but sooner or later the math is going to catch up with you, or even if it doesn't, it just becomes too stressful, right? Yeah. And all these things, both the thinking somebody knows something and trading too big, it has a negative impact on your zen, on your flow, on your mental capital. So the moment you realize that nobody knows anything, and that as opposed to what most people think, irrespective of what you're looking at, it's more than 20% a month. It's more like 20% a year is a killer year. Then infinite possibilities open up for you. That's not to say that you can't trade smaller, or you can't even smaller, or you can't trade even bigger, but everything comes at a cost.
So what we're talking about, this is it's so common for a lot of people who start getting into trading, etc., to trade too big. And I know I've had that problem earlier on, and it's essentially about greed. Like, people just want more than what they can really feasibly get consistently in the market if they want to do it long term.
Yeah, because it's being gamified, and they also think that it's kind of like, because it's being gamified, or what people think, it's kind of like a casino, right? I can go in and play. Wrong, right? You can always walk in and play a slot machine. You can always go in if there's somebody handing out cards. You can play any card game, but the market's not like that. There are times where there's nothing to do. There's time where there's no trade. And again, also the younger guys who, forget the Lambos, but think, okay, I'm going to start trading and I'm going to have a beautiful life and I'm going to drive a Ferrari, whatever, right? Now, but people don't think. This is the problem. Just think about it. Forget your returns, okay? Let's assume, forget that people start trading with a £100 account or 500 quid account, whatever. Most people that start trading, no matter what walk of life, no matter what kind of, broadly speaking, if I told you you're going to be making 250 grand a year, you're going to be happy, whether it's pounds, whatever, right? Of course, I'm going to quit my job straight away. I'm going to drive a Lambo and I'm going to go. Okay, so most people, you make 250 grand a year. Take an average around the world. You're going to pay 50% in taxes. You got 125K left. You got to live off that. You might have a family, et cetera, et cetera. You're going to spend £200-300 on a car? It ain't going to happen. Even if you make 500,000, you can't afford to go out like the people cash with a bag of cash and buy, because the first time you scratch it, you can't even pay, you can't eat. So the people don't even think, or like people get, oh yeah, I'm thinking I'm trying to make 1% a day. I'm like, really? Yeah. Well, it doesn't sound like enough. Well, get your Excel out and compound 1% a day and look at it, what it looks like on a year. Like, oh man. Well, yeah. So people just don't think. That's why I say realistic expectations is just try and compound even 0.5% a day. It's massive. So you have to think that, there's no money lying around. I think a lot of the investment books and stuff have done more harm than good, but people just don't have the heuristic because they're trying to do something that is not possible unless it's an outlier. And then what happens, the books, the blogs, the movies, most of the time it's not true. And when it's true, they're picking the outlier. And then everybody thinks that's the norm. So it's they're trying to do something which is just impossible, and which the way they're doing that is mathematically destined for them to lose their account. Yeah. Because if you have the right expectations, it's extremely doable. But you have to have the right expectations.
So how do you internalize these lessons? Obviously, there's always books around, even from like people that have experienced and talking about very good things, or even like this podcast where we're learning a lot from yourself. What's the best way to internalize these lessons? Or is there no better teacher than the market teaching you repeatedly over and again? I think there's a problem is that you can spend a lot of time reading books, a lot of time looking at charts, and learn nothing, or learn the wrong things, which is even worse. And sometimes, when I talk through somebody through a chart or something, I go, I've been trading for 5 years. I watch charts every day. And then you explain what's going on a naked chart, and like, oh, they had no idea, right? Mm-hmm. So I think what you should do is, by all means, and especially if you like trading, you have to be passionate and enthusiastic about it. So by all means, go out and read everything you can, listen to any possible podcast, try any possible indicator, but just don't throw your common sense out of the window and think. Think. It's just so easy to do, yet so many people don't. If somebody tells you, oh, the classical sales pitch, people go, oh yeah, these guys on Instagram, they said they're making 50K a month off a 10K account. It's crazy. Look at me. I trade responsibly. I have a 100K account, but I only make 10K a month. Well, do the maths. Do what that means on a year compound. The guy would buy, a country in a couple of years' time. And the smartest people fall for that mistake. But I think it's important to think. Now, personally,
the truth is that I would strive to, again, if you have an inquisitive mind, so it's important, you're going to have to make mistakes. Everybody has to make mistakes. If people only learn through making mistakes, really, you can tell 100 people, don't do this, don't do this, don't do this, until they do. So stay small, because at least if you're trading extremely small leverage, you can make all the mistakes you want and still not blow up. So that's a first step. Accept that you're going to make mistakes. Just make sure that you don't make the same mistake more than a couple of times. By all means, experiment to try and find what works best for you. But usually you'll see that you'll go round circle and you'll go to something very simple, because the simple stuff is what tends to work. The simple, but there's no easy answer. It just takes time. It takes dedication, and the willing to put in the time, and not only the time, but to do things properly. It's a hard one because people want a quick answer, a quick solution, a quick fix, similar to people who go to the gym or want a better golf swing or a better squat or whatever. And the reality is that, first of all, the answer is probably different for everybody. And second of all, the solution will be simple, but finding the answer is probably not going to be easy or quick.
Yeah. But it's the same in being successful in almost any walk of life. It takes time and dedication to get there, I suppose.
Yeah, but people won't accept that for trading.
Yeah.
Anybody will accept the fact that you can't go out and operate on a live patient unless you've done 7 to 8 to 10 years of med school plus residency, et cetera, et cetera. Everybody will accept that, you can't, but for some reason, they think they can start trading, quit their job, and make millions. Mm-hmm. When nobody around them they know has ever done it, right? But for some reason, and everybody falls in this category, you have this dream of you being the only one. And, oh, yeah, I know you shouldn't trade leverage, but I can do it. I know you can't compound 1% a day. Well, but watch, I'll do it.
It's always it's the feeling that, for me, it will be different. Everyone else, it'll be different.
Unless one day, it's kind of like I say, it's kind of like showing up to AA, right? You can't take somebody. Somebody has to wake up one day, look at the mirror and say, this is my name and I'm an alcoholic. Yeah. And that's when you make a conscious decision to change. Unless you make a constant decision to change, it's never going to happen. And because I think fundamentally it's just you in front of your screen, nobody around you, whatever, is extremely easy to lie to yourself or to just wire in a little bit more money into the account. Forget about that. Just, okay, it didn't happen. Let me start again. Didn't happen. Let me start again. Didn't happen. Let me start again. But if you've been doing that for years, you need to wake up, right? Then trust me, it's much funner to go and bet on something else, because it can't be fun. If you want to, it's okay to finance a gambling habit, but there are much funner ways to do it than levering up and all the stress and getting killed in the markets, right? And the problem is most people like to think they're trading and they're being professional, but they're just financing a gambling habit. It's the same thing. Look at the guys that start on Instagram or on Twitter. Everybody does it. I had a talk with somebody, they have to choose a handle, or I'm not going to mention another platform. I told some people to sign up somewhere, right? And I said, choose a professional handle or whatever. What do people sign up as? FX Guru, Slayer. What the F are you thinking, right? Or then you read people are answering you on Twitter. You post something and then you get a stupid answer and you're like, who the hell is this? You click on it, right? And there's a photo of them doing a shot or something stupid or whatever, and then it says hedge fund manager, blah blah blah. And you just look at it once and this guy's like a piker living in fantasy world.
Yeah.
Yeah, nobody apart from the fact that nobody in their right mind that's making money is going to want to go on Twitter or whatever and tell people how much money they make or show them their account, whatever. But people come and they describe themselves, or when they talk to you, I'm a star trader, I'm a master scalper. Everybody's living in fantasy world. So a dash of humility and wanting to learn will go a long way, but if you start with calling yourself a trader, you haven't even started. Or if you tell yourself, you live in fantasy land, or if your profile pic is a car that you couldn't even afford to buy a picture of, right? It's destined to not go anywhere.
Yeah, it's good lessons to try and learn. And I hope this helps a lot of people that are
it's just
listening.
try and be it's not going to work for everybody, but in general, try and be as responsible or as diligent as you are in other things in life. Yeah, most people spend more time, as I always say, deciding what mobile phone plan they're going to get rather than blowing 2K or trading non-farm payrolls release. People spend like a week discussing with their better half what refrigerator they should get, and then they just open up a platform, send some money, and start trading. So just try and apply the same common sense that you would to other parts of your life in general to trading too, and things will probably be a little bit better, hopefully.
So just to finish up the podcast, I'm just really interested to know, what do you consider your edge in trading? What have you learned over the years that gives you sort of like your edge?
What gives me, I'm trying to think the root cause. What gives me me? That's my head. It's just the way I think.
The level head.
Just the way I think. There are probably a lot of things, but it's just the way you could say, I could say, oh, the way I manage my risk or this or that, but ultimately it just boils to realistic expectations to doing what I need to do. Yes, what I would say is there's one thing that, and it's just me, right? But, and I joke about it on Twitter, is I know that come rain, come shine, whatever, I'm going to be in front of the screens for London Open and I'm going to trade.
Yeah.
That's going to happen. I've done, I run some webinars. I've had webinars where I had a dialogue box open on the chart and I was writing it because I had a fever and I had no voice. It's not because I'm a hero, but that's just, I get shit done.
Yeah.
So I'm not, So my edge is just, I know what I need to do and I do it. And that's just not negotiable. But that's pretty much with all aspects of my life.
Mm-hmm.
But do I have anything special power? Do I have a special indicator? Do I have a special system? Do I have special risk management? No. It's like what most people say. You could publish rules for what you do, give it out for free. Nobody would have the same. Two people wouldn't have the same results because people just, say you give 10 people the same diet, even if they were clone somebody, so it's the same body type and give them the same diet, whatever, they probably have different results because people just don't do what they need to do.
Yeah.
And it starts from showing up. Showing up and doing what you're supposed to do. If you said you're going to do this, if you said you're going to trade, take this kind of trade with this kind of leverage and do this, if this have this. You got to do what you need, you got to do what you need to do. But if anything, I think I think probably people who know me or even my people would say the trait I have is just revolves around willpower, right? If no shortcuts and willpower. If I got to do something, I'll do it.
Yep.
But again, I don't think I have a special. I think that's the case for every trader. Ultimately, and again, I'm just thinking about it now, so I might be off the mark. After we hang up, I might change my mind. But I think really, is there another answer to ultimately, if you boil it down to the essence, any trader who has edge isn't the edge themselves? Because I can give you a system that's guaranteed to make money. But if you don't respect the rules, if you don't click on the button, if you don't do what you need to do, the system is useless. So, right, it's to a certain extent, somebody who plays guitar beautifully, you could give them a $5 old used guitar and it's going to sound awesome. Yeah, you might have some exceptions, but everybody's edge really ultimately is again, unless I'm not Citadel, right? So then the answer would probably be different. But I think for a private retail trader, your edge, if it doesn't come from you, I don't know where it comes from. I don't know. What do you think?
Yeah, I mean, this comes back to the psychology angle, doesn't it? I mean, it's a constant game trying to win against yourself, and that's a challenge. Is that it takes a while to get to a point where you overcome that, and you can sort of counteract the things that you know are wrong and you shouldn't be doing. And when you have the willpower, like you say, to manage that and control it.
Yeah.
And you have to come into that manner. That's the hardest bit as well.
Oh no, you have to come to every day just knowing what you know, knowing what you don't know, and do it right. Then again, I always run in parallel in the sense that what I do is extremely basic and extremely, regimented. But that's everything from when I wake up, what I eat, what I do, So, but at the same time, in parallel, I'm always trying to work on something new, right? So I'll be listening to podcasts. Somebody might send me an indicator. Look at this. I might look at it for 3 seconds or 4 days. I don't know. But there's always going to be something in parallel going, right? So, but what I found is over the years, it's funny, but most of the things I look at to try that work on usually help me reinforce that what I'm doing works. But where I'm getting where I do get better, where I'm getting better every year, is at applying what I know and filtering out my bias. Maybe that's more concrete answer. What I'm good at is I'm pretty good at is every year I have less bias than I used to, because you're always going to have some. But I'm pretty good at that. I work at it. So, sometimes you might know certain things are likely to happen. This will happen 9 times out of 10. This is the seasonality, but you will still kind of fight it a little bit because you have a bias. And I work hard on myself to get rid of that. And I'm pretty good at it. I'm not perfect at all, but I'm good. This year, I'm particularly happy because I got a part of 2019, I got stuck feeling a little bit bearish that this thing's crazy, man. This has to go down, right? And I got stuck in that mindset for a couple of months. And I also, because I got paid on that in May and in the summer. But then come the end of the year, those last months of the year, I started trading a lot to the long side. And then instead of getting bearish, as I should have gotten, like getting bearish coming into the year in January, which I almost thought, there you go, I'm going to get bearish again because we had that sell-off beginning of Jan.
Yeah.
And we didn't break down any key average, and I stayed, and then I got bearish again in March, and I knew myself there. I was thinking about, okay, this shit's going to unravel big, right? So there's got to get 50% correction. We got to get a 50% correction, and then this is what helps also me doing my daily webinars and stuff, because it really wouldn't be the same if I weren't accountable to people every day like that. And there I was very careful to paying attention to what the market was doing and what the market was how the market was reacting, especially when Powell came out at those lows. And this year from then, I've been trading very aggressively, both the long side and the short side. I've really been able to keep my thoughts in the corner of my mind, but just purely trade the price action. So so I think that's one thing which I'm good at over the years. Is one more specific thing is that I really work hard, and I'm getting better at that. It always doesn't translate into perfect, but I'm really reducing my bias a lot.
Awesome. Well, that's great, 50. I think it's been really great to have you on the podcast again, and really valuable lessons for everyone.
My pleasure.
It's been great, and always great to get your insight on the current markets as well. As we were talking about, you remove the bias, and it's good to give people that if this then that scenarios on both sides, and hopefully by doing this more often, we can help teach other people to sort of think in that way as well. And as always, if you want to follow 50, you can go online, 50pipsfx.com. Believe that's right, 50?
Yep.
Cheers, 50.
Thank you. All the best.
Of the week. Cheers.
Same to you. Take care. My pleasure. Bye-bye. Thank you.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.